Hello, friends. It's been a hectic couple of weeks in the economic landscape, reminding us how data shapes our shared journeys. This is Eyal Tropen with your Economic Pulse Check. I'm here to break it down in plain terms. Let's start with the big news. The Federal Reserve cut its benchmark Fed funds rate by 0.25% on September 17th, the first cut since December of last year, setting the target range between 4 and 4.25%. It was widely expected as the Fed tries to balance between inflation and a weakening job market. The Fed Chair, Jerome Powell, put it bluntly, there is no risk-free path moving forward. The Fed's own projections show how much uncertainty we have. Out of 19 official members of the Fed, 7 expect no more cuts until the end of the year. 1 sees a rate hike, while 9 predict 2 more quarter-point cuts by the end of the year, which is the expectation. But here's the kicker. As I've said before, the Fed has been working off inflated job numbers for months now. If it had accurate data from the start, we likely would have seen these rate cuts come much sooner. Now, you might be wondering, if Fed rates were cut, why did mortgage rates tick up to about 6.13% on the 30-year fixed average mortgage loan? Simply, the markets move ahead of the announcements. Rates have been already dropping since August 22nd, when Powell signaled he's expecting the cut. By the time it happened, it was already priced in. Some investors even sold off, a classic sell on the news move. However, the Fed fund rate isn't the mortgage rates. It does help nudge them over time. So with 2 more cuts that we expect to have by the end of the year, we could see borrowing costs ease even further. On the job front, talked about it a second ago. I've been warning about inaccuracies in the job creation counts for a long time. Now the truth is finally out in the open. The latest numbers prove it. The Bureau of Labor and Statistics, the BLS benchmark revision, erased nearly 911,000 jobs in the 12-month period ending March 2025. When you factor in the series of downward monthly adjustments that we've been having every single month, the total correction from the initial reports for the period is a staggering 1.2 million jobs gone, erased, never created. Sectors like leisure, professional services, and retail took the biggest hits. August report didn't help either, with just 22,000 jobs, the weakest in years. This confirms the slowdown. In housing, construction slowed in August, and builder sentiment is still low, but there is hope. Many builders are optimistic that with the expected Fed cuts, if we see mortgage rates keep going down, we might see some buyers come back to the market by the end of the year. Inflation, meanwhile, clocked in at 2.9% for August. It's above the Fed's 2% target, but cooling. With job openings at their lowest since last fall, it's all hinting that the market is finding its balance. If you have questions about buying, refinancing, or the market, I'm here to help, so reach out anytime. And on a different note, we celebrated the Jewish New Year just a couple of days ago. As I reflect on the foundations we're building, and while we each might take a slightly different path, most of us are heading in the same direction. What gives us strength is the understanding that we're in this together. May the year 5786 bring us the wisdom to focus on what truly unites us, not what divides us. Building a strong future both in our communities and in our financial lives. This requires intention and purpose. So here's to a year of health, happiness, and continued progress towards our goals together.